Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates, jobs, and the homeownership rate. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. And my, look who came to the party as we wrote on January 23rd. If the administration really wants to, talk about getting mortgage rates lower, they're going to need Treasury Bessent to come out and talk about, we want the 10-year yield lower, not focus too much on the Fed funds rate, even though I believe that does need to happen. And that's what occurred yesterday. That was the big talk.
Okay, so let's talk about what they can do. So, Fed funds rate, if he's not focused on that, he's focused on the 10-year, what can Scott Bessent do about that?
So this is my understanding, just from what I know. Obviously, nobody wants the 10-year yield and mortgage rates to go up higher, right? We wrote that case in December, right? The wild card for 2025 is the housing market, residential construction workers. The last thing you want to deal with is an early recession or unemployment rates going. Manufacturing jobs were lost last year. So what happened? The 10-year yield, of course, went up. And, when Mnuchin, the former Treasury Secretary, said 4.5% is a cap, that's kind of where we want it. For the 10-year yield to get above that, it's probably within the administration, not something they want to see. We got up to 481, I think, this year. I think the peak forecast for me is at 470. So to get the 10-year yield up higher than that, you need economic growth to be booming, inflation, things like that. And if that's not occurring, then what it is financial conditions are tighter than what they should be. The bond market was heavily shorted, which means people are betting money on it rising. I believe part of this is to kind of spook bond shorts, just like how a CEO doesn't like traders shorting their company and calls for a stock buyback or something like that. I don't know if this is going to happen or not, but I believe Jamie Dimon from JP Morgan and Musk are going to be presenting something to bond traders. Just speculating here if that's going to occur or not. I don't believe they feel comfortable with yields accelerating. And again, we go back to the November 7th podcast, trade war tap dance. We saw what happened with the tariffs. Now they're coming in with the big guns and saying, we would like the 10-year yield, which means you want mortgage rates to go lower. If the 10-year yield just ranges between 380 and a 4.25 with normal spreads, I think everyone would be fine. You'd have 6% mortgage rates. If the spreads improve, even from where they are right now, you have mortgage rates with a 5 handle. Then you can get the builders start issuing permits and home buying will grow again. It's not the sub 5% market of the last decade, but it's good enough to alleviate some of the recession scares. So as of right now, it's try to talk a market down. They can issue the supply of bonds or what they're going to borrow, kind of like what happened before with the Biden administration. But really, I calculated this with one of the Wall Street economists on Twitter today. They really need the Fed funds rate 1% lower. And if you get 1% lower the Fed funds rate and a dovish Fed, I think they'll be okay. If the spreads improve a little bit more, they'll be okay. That's kind of it, right? There is no pushing mortgage rates back down to what we saw in the last decade or anything like that. But that is workable. And that's more of a plausible case that could be made. But again, there's so much talk about trade wars, tariff, inflation, all this stuff, and bond yields are, not productive for anybody. So I thought that was just, again, what we wrote about in January 23rd. He needs to come out, not Trump. And he specifically said, we'd like the 10-year yield lower. Trump doesn't want rate cuts. He wants the 10-year yield, but you do need like 65 to 75% of the move really with the 10-year is Fed policy. This is why the 2-year yield and 10-year yield tend to move together. And it's the start of the year, and this is it's just going to be much more interesting the next 4 years. So
yeah, you could call it interesting for sure. So there's nothing, overt that they're going to do in your opinion, or can do. What they're really going to do is they're trying to influence the bond traders by what they're talking about
No,
and what they.
they could do some issuance of, shorter term debt versus longer term debt, just to bring in less supply. That gets into a little bit more complicated discussion. I don't want to get too involved in those weeds, but generally what I'm seeing is that they're trying to convince bond traders not to short the 10-year yield. And then if they could get the Fed on board, and then, Waller talked about, maybe we need, we can get 4 rate cuts. Now that 4 rate cuts is meaningful, because to me, what they really need is 1% lower in the Fed funds rate, short-term rates, everything kind of smooth, and you're working with a lower base that the 10-year yield can work off of. The Fed is still restrictive in that sense, but the 10-year yield is pretty much priced where it should be, considering all the variables. So it happened a little bit sooner than I thought. But when we wrote that piece about, he needs to come out, that within less than 2 weeks that happened. So, and now the 10-year yield as of this morning is 4.44. Last time I checked, mortgage rates are sub 7%, barely, but I think there was a concern on everyone that if mortgage rates kept on going higher and higher, and the Fed does what it usually does, ignores the housing market, residential construction lose their jobs, unemployment rate goes up because private unemployment jobs are being lost. That doesn't do the administration any good, and the Fed is typically behind the curve on this. So it just makes everything interesting going out now, because we have now full set, hey, listen, this is what we want. We're going to do what we can to get it there. And it makes the Fed meetings a little bit more interesting on the Q&As. And because now Scott Bessent is the head of Treasury, and we'll take it one day at a time. Sarah, I know we're doing this 3 times a week. We should be doing this five days a week, because every day something comes up and we got to talk about it.
Every day something does come up. Okay, so before we go on to jobs, which is our next topic, let's talk a little bit about tariffs and where that shook out, and how that is affecting mortgage rates, or if any of that talk or any of those things are affecting mortgage rates right now.
So bond traders can overbuy the bond market and they can oversell the bond market. So considering where economic growth is at 3% GDP, again, there's nothing abnormal about where the 10-year yield is going. But I think everyone was there. I think the bigger concern to me from the administration is that the bond market was heavily short, and things could get wild short term, in that they wanted to just kind of squash that. And the 10-year yield is almost down 40 basis points. I think at one point it was down 40 basis points from the recent highs. Scott Bessent isn't a trade war person, and just like myself, talks about it being a loaded gun that you're never going to shoot. It's really designed to try to get manufacturers. This is the whole premise of a trade war tap dance, not a trade. If you really believe in the concept of tariffs, you just put them in and you leave them there, and then you try to find ways to go around other countries' tariffs, and it's a whole process. Scott doesn't really believe in that. It's more about trying to get manufacturing jobs back. Again, the dollar gets strong again, and it all falls back to the dollar, really. And I'm encouraged, because I see more and more people asking about the dollar, which is just like, makes me smile. But the tariff headlines and bond yields going up higher, of course, there's a lot of Wall Street firms talking their books. They were short the 10-year yield. They highlighted the tariffs and inflation as their reason. So it's just a lot of, to me, a gamesmanship between the White House and bond traders. And it'll be more interesting to see if that occurs with Musk and Jamie Dimon talking to bond traders about their plans about reducing the deficit and getting less supply out there, and trying to drive down. Because what Scott Bessent's plan is really 3% GDP, 3 million more barrels produced a month. I don't see how that's going to happen. But a lot of this is bringing oil prices down and energy prices down, not just for here in the U.S., but globally as well, which a lot of countries need elevated oil prices to keep their budgets going. I just always like to remind people that we had lower mortgage rates with higher oil prices and gas prices the previous decade. Go look at oil prices from 2010 to 2015 before the shale boom started. We also had higher mortgage rates with a lot lower oil prices in the 1990s. Go back and take a look at oil prices and look at where mortgage rates were. So it isn't like 100% this is the thing, but I could see if the disinflation from lower oil prices happen, they feel like the Fed can be more dovish, and we don't need, 1% cut in rates and a dovish Fed gets you into a workable. We're just talking about a workable premise. This is like, for me, it's like I can't forecast below 5.75% unless the Fed starts to get a little bit more dovish, but you can get something working if mortgage rates get towards 6%. It's the 6.75 to 8% mortgage market that isn't doing anyone any good. So we'll see. Like I said, this is why every single day you have to track this stuff, because something comes out of the blue and it's a variable that needs to be discussed.
Love that. Okay, we are recording this on Thursday. Tomorrow is the big day, jobs report. What do you think is going to happen?
Oh my, I think the podcast comes out right when jobs report is going to come out. Okay, so a few things. Number one, so far this week, I would say that the labor data has been softer. I know the ADP beat. Nobody really cares about the ADP. I'm sorry, but that's just the truth. We have to say it's part of the jobs week because sometimes it does move the bond market on the day. Job openings, of course, job openings were lower. The quits and the hires are low. So it's the same market. We're going to get the revisions tomorrow. So just one thing about revisions, I know a lot of people are saying there's 800,000 less jobs. The job market still, even if that occurred, roughly is kind of where I thought it would be in 2024. I was always wrong. I was always lower than everyone else's forecast. But now with the revisions, the revision itself, the 6 month is basically at the peak of my 2024 forecast for job creation per month. So we'll see what happens with the revisions in general. But again, the Fed is, labor market breaking, right? Jobless claims. You've had a softening of the labor market for now 14, 15 months now. Manufacturing jobs were lost in 2024. Residential construction workers, if they lose their job, that ties with every single recession we've seen in recent modern day history. These things should be very evident and apparent, but I've always said the Fed doesn't care. They keep on saying, the labor market is strong. It's softening the economy. So they kind of consumption GDP is running. So they're just going to be as financially tight as possible until the labor market breaks. So tomorrow will be a good day in seeing how the bond market reacts to where we are now. We're obviously off of the 480 level where we've come down enough, but look at wage growth, look at the revisions, look to see if any Fed president says anything. But jobless claims, again, is the key to everything. Jobless claims picked up just a little bit out there, but the continuing claims just shows it's a soft, if you have a job, you're okay. But if you're looking for a job, not the best. And it's a little bit more difficult now with elevated rates and moving. So there's things that can alleviate this. But as we talked about in 2022, they're going to wait until the very last, them cutting rates 1% is a big deal because, the market has already lowered the rate bound. It's just not enough to where people thought if the growth rate of inflation falls that we'd have sub 6% mortgage rates. Not in that camp, but that's what so many people were waiting for. And I tell you, the White House, the Treasury, everyone would be happy if that was the case. We're just not quite there yet.
Well, and earlier you're like, you could see it, if we're under 7 now, great. If we could get under 6, if we got to 6, like just at 6 or a little bit under, huge spring home buying season.
Again, every year that goes by when you're working from the lowest levels of home sales ever recorded in history, that intangible household formation, wages, people, you're missing millions of home buyers that would have been here in a normal thing. So it just builds up. And early 1980s, that's what a lot of people said. We're a renter nation. Nobody was going to buy homes. When mortgage rates fell. Now, of course, there was a recession back then that pushed rates lower. When that occurred, we had a vertical shot up in demand, and affordability was worse back then, and we had more inventory and a recession, right? So everybody would be happy if mortgage rates were at 5.75 to 6.25 rather than 6.75 to 7.25. I mean, that's just kind of it. So when Fed President Waller says we might have 4 rate cuts, I'm wondering in the background if there's quietly some kind of discussion going on about, listen, if you can do these few things, then we could get more. Because if the Fed cuts 1% and they sound dovish, makes everyone's life easier out there. And of course, the spreads have gotten better this year. That's saved it. But imagine if the spreads were as bad as they were in 2023. We were talking 8% mortgage rates. No, the market's not functionally working, and that's more strain to the builders as well.
Let's talk about homeownership rates. So you wrote an article this week, and I thought it was really interesting because we were looking at what does the Census Bureau say the homeownership rate is? It was pretty high, considering. So I would like you to talk about how high we reached, why it's not higher, and what's the highest that we've ever reached.
One of the craziest calls that I made in the last decade is that how I've formatted the previous decade was that we were going to have the weakest housing recovery ever. And because homes were so affordable back then and mortgage rates were so much lower, a lot of people didn't agree with that assessment. But I said millions of people buy homes. But what you're looking for the mortgage purchase application data to get to 300. That's not going to happen until years 2020 to 2024. You're not going to get housing starts to get to 1.5 million until years. All that occurred. But one of the more controversial calls was during that period of time, I said the homeownership rate is going to get down to 62.2 to 62.7. Household demographics, we have a lot of people in the renting age. You need massive deleveraging happening. People, when they short sale and foreclose their house, they are no longer homeowners. So we're going to get there. Now, that was a very, very aggressive call. We got to 62.9 in Q2 of 2016. So missed it by this much. Then all of a sudden, household formation grows. Millions of people buy homes. Here comes the millennials. Credit markets are much better now. You're not seeing more foreclosures. We should get to 66.21 homeownership rates. Near 70 was the high during the housing bubble years, which I say is artificial. That was not real. By years 2022 to 2026, we got to 66% so far, 3 quarters in the last few years. So we're almost there. And if home prices didn't escalate out of control and mortgage rates didn't escalate out of control, we probably would have already reached that. I do not count the sharp spike that we saw during COVID. That was an accounting error. So considering all the variables we had to deal with, prices and rates, it looks at 65.7%, looks fine to me out there. Again, 1/3 of all society are lifelong renters unless they get married to a dual household income. So the percentage looks normal. Again, when you have a big group of younger Americans coming in, they go from renter to ownership. And then if you don't have foreclosures and short sales in very big forums, you're not losing that side. Again, 70 to 80% of all homeowners who sell their homes are home buyers. So everything looks about right. If anything, it's probably stayed a little bit higher considering how much home prices have gone up or rates have gone up. So the state of home ownership looks normal. I know first-time home buyers, that's a percentage survey that the NAR does. It's at 24%. Just remember, millennials are still the biggest home buyers in the world. Now Gen Z is coming in. And a lot of this has to do with the credit data. And that's what we highlighted in the article as well, right? If you don't have people foreclosing on their homes or losing their houses, they will be technical homeowners on the census until they do. And delinquency ratios or everything is still, as a percentage, very low.
I think I think you're right, where that's kind of the sweet spot for our nation. In fact, if we didn't have that demographic push that you talked about so much when we first started doing our podcast, and when you first started writing for HousingWire, almost all of your work was about the demographics of 2020 to 2024, because you had all of these millennials reaching peak home buying age. And so I feel like with that push has gotten us where we are, because it's not like there's some exotic loan debt structures out there, as you talk about. It's not like, oh, we're just giving houses to everybody.
What do we always say? The skit, we're not complicated people. We rent, we date, we mate, we get married. 3.5 years after marriage, we have kids, dual household incomes. Highest percentage homeowners are married couples. there you go. And if people ask me, how are people buying homes with home prices where they are and where rates are, if you need $103,000 to $110,000 to buy a house in America today, dual household income solves that. That's why dual household incomes was a big part of our work in the last decade, and we're highlighting that now, because if rates go lower, the pool gets bigger, right? Every 1% rates go down, the pool naturally gets bigger, and if it goes down again, pool gets bigger. Now, if rates go up 1-2%, the pool becomes less and less, and that's what we've seen here with existing home sales, basically hovering right at that 4 million, back to back, did not break. Right, we stuck just a tad above 4 million. Isn't that crazy how that all worked? That was like one of our things early in 2020. Talk about it. It's really rare for existing home sales to even trend below 4 million, but to close a year under 4 million after 1996 just hasn't occurred. And even with everything we've dealt with recently, that's been the case. So it's just a testament to having a massive young demographic patch, right? If we didn't have millennials and Gen Z, we're looking like Japan. I mean, both those two generations together are bigger than the total population of Japan, and 40% of Japan's population will be dead by the end of the century. That's not good for economics, and they sell more adult diapers than baby diapers. So not another good thing for economics as well.
You and I were at an event, and you said that on stage, and everybody, the reaction of the crowd when you said they sell more adult diapers than baby diapers was just, people were just like, did he just say it? They were just laughing.
Yeah, but like, it's true. It's true. It's like, I know, I mean, sex, death, everything, all these things are really important things for economics. And when you're an aging society and you don't have a younger workforce replacing that group, and you don't have immigration, I mean, for Japan to basically accept immigration tells you how bad it is over there. Okay. So that is a society that has not enjoyed immigration for a very long time, but robots can't do all the jobs, Sarah. They can't do everything. So that's why they're finally opening up to immigration. And that's really, I mean, there's a lot of countries that are very young, and the Middle East, Africa, India, and then there's a lot of older countries that, Europe, Japan, China. Nobody has a Dorian Gray labor market. I use that always because we all age, nature wins, and then we die. And when we leave the workforce, we need to be replaced. And if it's a growing economy, you need labor out there. Speaking of which, because of Bassett, we got to do the slow dance song again. So I got to sing Shy. The very first time that I saw your brown eyes. But I was thinking, I got to start bringing, other songs in. I was like, do I bring, I can't bring Color Me Bad. I don't think Clayton would like that. Richard Marx, Rod Stewart, Brian Adams. I don't know.
You're going to be like the singing economist. You keep singing.
I'm telling you, it's the slow dance is working. People starting to get it, right? The 10-year yield, 30-year mortgage, bond, and then I always say that, we want an intimate slow dance. We want them close together. And when the spreads are bad, that means the guy probably did something wrong and the slow dance is wide, and that doesn't do any good. And that's what we're dealing with still. I mean, the spreads are getting better. Mortgage rates would be near 8% today if the spreads didn't get better. So I thought if I explain it that way, that might be interesting, and then people would get it. And now whenever somebody sees the 10-year yield and 30-year mortgage chart, it's like, oh my God, wait a second. Yeah. And then the spread. So we have to say things for people to relate to and then have some fun with it.
That one has been super popular. We are out of time. Thank you so much for being on. And listeners, if you listen to this and then you look at the jobs report, Logan always writes up an analysis of the job report on that day too, so you can check that out. Logan, thanks again for being on.
Pleasure to be here, Sarah.